Okay, so there are more developments on the ISA reform front. And if you're an investor, then I don't think you're going to like the latest round of speculation. Let's rewind to last week where cash ISA reforms hit the press, with speculation suggesting that the cash ISA allowance could be reduced from £20,000 per tax year down to just £10,000, all in an attempt to encourage the British public to put more of their hard-earned savings into a stocks and shares ISA. The reason for this is that Rachel Reeves wants to drive investment in UK equities to help support growth and provide better returns for investors. But there has since been more developments whereby this initiative could have a greater impact on the stocks and shares ISA, which I don't think is going to be all too welcomed by investors. All of which I've been able to discover in this Financial Times article, which is titled Reeves looks to include minimum UK shareholding in an ISA overhaul.
I want this to be a pro-growth budget that maintains Britain as a great place to start and grow a business and to bring in investment.
Okay, let's start off by talking about this potential new requirement for a minimum allocation towards UK shares within a stocks and shares ISA account. From what I'm reading, it appears that Rachel Reeves is consulting with firms, I assume financial companies in the city, who are allegedly pushing for a minimum allocation to UK equities between 25 and 50% within ISAs. Now, my immediate reaction was that a 25 to 50% UK asset allocation seems a little bit excessive, and just based on the range that's being provided within this article, and trying to read between the lines a little bit, I'm going to suggest that these numbers are kind of being bandished around and are probably nothing more than hearsay than anything else. At this stage, it very much appears like we're just plucking numbers out of thin air just a little bit. At the same time, I feel like most people, myself included, use a stocks and shares ISA so they have flexibility and control over their investments. And this kind of feels like the government are almost selecting our own portfolios, which, if I'm honest, probably doesn't really sit right with me. However, let's say that Rachel Reeves does go on to say, well, everybody needs a minimum asset allocation of UK shares in their stocks and shares ISA accounts. What exactly does that look like? Well, let's try and unpack that a little bit, and I'll try and remain as objective as I can. Let's just say, hypothetically, that the minimum allocation to UK shares is 50% of a stocks and shares ISA. If we're looking at the higher end of asset allocation, then my first thought was then surely most of, if not all of, the tax benefits of investing inside of a stocks and shares ISA will be eroded by the loss in returns from investing into UK equities, as opposed to better performing other markets. Quite a bold statement, but let's flesh that out a little bit to see if it kind of rings true or not with some analysis. If I say I had £10,000 available to invest in a stocks ISA, based on today's current rules where I could invest in whatever I wanted to, and say I selected a globally diversified market tracking exchange traded fund like a FTSE All-World, for example, my historical performance over the last 20 years would have been about 10.1% per year. Past performance, of course, isn't indicative of future results, but let's just pretend in this hypothetical scenario that these returns over the last 20 years would also continue for the next 20 years into the future too. Now, of that FTSE All-World, only about a 3 to 4% asset allocation actually goes towards UK equities, depending on which fund that you look at, which may not be anywhere close to Rachel Reeves' desired target. Now, let's say that new rules came into play, where Rachel Reeves enforced a minimum 50% asset allocation towards UK equities. So we would invest £5,000 out of our available £10,000 into UK stocks, and then the further £5,000 into the same FTSE All-World Global Market Tracker. In the last 25 years, the compounded annual growth rate of the FTSE 100 has been 5.21%, with the FTSE 250 achieving a compounded annual growth rate of 8.48%. Now, if we take an average of these two returns by blending them equally to get adequate exposure to the UK markets, then you actually get returns of 6.8% per year. And again, let's hypothetically say that we achieve these returns for the next 20 years into the future too. Whether we do or not is absolutely up for debate. Now, mapping these two scenarios on a £10,000 investment, here would be the end portfolio values 20 years from now, given these two hypothetical scenarios. You'd have £74,748 with a pure 100% investment in a FTSE All-World, or a £56,780 portfolio with a 50% exposure to UK stocks and a 50% exposure to the rest of the world. You can see that you'd be worse off by £17,968 with a 50% allocation to UK stocks, or a 24% lower portfolio value based on historical data anyway. In this scenario, which I admit has its limitations in order to keep things broadly simple, most of, if not all of the tax-free benefits of the ISA would simply be eroded from a worse performing portfolio, not exactly delivering this initiative's desired outcome of providing better returns for investors, especially if we consider if we put the better performing portfolio of the FTSE All-World into a general investment account, which is actually a taxable account, and then still paid the 18% of capital gains tax for a lower rate taxpayer, then you would have only lost £11,114 in taxes. Even the higher rate taxpayer would actually be better off paying the 24% capital gains tax bill, because that would only equate to £12,539. Now, I've worked out these calculations based on the capital gains only, and I've excluded any dividends that might have been received, so again, some limitations here. But I've also assumed that you will have also used up your capital gains tax-free allowance, which currently sits at £3,000 per year, as at the current tax rules. Of course, this example is a little bit extreme at the 50% allocation end, and Rachel Reeves might actually enforce a far lower asset allocation towards UK equities, or she might not have any kind of minimum requirements whatsoever. However, what I hope to demonstrate is through this example just how important and critical it is for these kind of initiatives to be well considered before making any policy changes on them. Because to me, it really does start to raise the question as to who are going to be the actual beneficiaries of these types of policies, and whether the intended beneficiaries actually end up being the ones that benefit. The other aspect to this is what actually constitutes a UK stock, and how can any additional retail investment fund flows actually be guaranteed that they're going to benefit UK companies, and those UK companies to then go on to reinvest that money back into their businesses, potentially provide more jobs, and essentially contribute to additional UK-only economic activity. Let me explain exactly what I mean by this. According to a government official, Reeves wants to ensure any investment unlocked through reforms benefits UK companies and growth, so it's important that the reforms do just that. But according to Fidelity, the FTSE 100, which is the top 100 companies listed on the London Stock Exchange, 80% of their revenue is actually from overseas, showing that the FTSE 100 isn't just a bunch of companies that operate solely in the UK. In actual fact, most of these companies have large operations completely overseas. So in my mind, I think it might be very difficult to quantify the benefit and the impact of any additional retail investment fund flows into UK companies and how that actually translates into UK economic growth, especially when we consider the very nature of the London Stock Exchange is that, well, it's internationally focused. On the flip side though, yes, I guess this could open up additional capital investment for small to medium-sized companies who are more domestically focused and deriving most of, if not all of their revenues here in the UK. And in theory, that would be a good thing for business investment and growth. But I do also fear that Mr. and Mrs. Rogers aren't exactly going to want to be looking for the next hot IPO, neither are they going to be looking for some kind of small to mid-cap stock that has huge potential growth opportunities, when all they want to do is put their money somewhere safe for retirement. And even 30-year-old me, to be honest, I just want to put my money in some kind of market tracking index fund and chill out. I don't want to be looking for the next kind of small to mid-sized company as a retail investor for huge potential growth opportunities, especially because of the risks involved. And that's before we even start to consider all of the logistical challenges that this could present for retail investors, for platforms, and for fund managers. Would we need to proactively manage our portfolios? Would we have to actively make buying and selling decisions if we became over or underweight in our allocation of UK stocks? How would other platforms enforce it? Would they be mandated to automatically sell our non-domestic investments if we somehow became underweight in UK equities due to outperformance of other markets? These are a number of questions that I have, but if I'm honest, I do think all of this is kind of largely unrealistic. And I do hope that there will be a far simpler solution presented as opposed to enforcing everybody having a minimum asset allocation to UK stocks within their stocks and shares ISA accounts. Quick side note though, I've just launched a completely free newsletter called Financial Notes. The first edition went out last week to provide a full stock market update and the latest details on cash ISA reforms. So if you do want to stay up to date on the latest market insights, then be sure to scan this QR code here or click on the link down in the description below in order to subscribe. The other positive that may come out of all of this, though, is the potential removal on stamp duty on UK share purchases. In my last video, I said that this would be a long shot, and I do still think that it is, but latest reports are saying that financial institutions have met the Treasury to discuss removing stamp duty tax, which is currently 0.5% of all London-listed shares held within ISAs. Public Policy Director of AJ Bell has also stated that if Rachel Reeves wants to plant a British flag in her ISA reforms, she should review the impact of stamp duty on UK shares rather than attempting to revive the fundamentally flawed UK ISA proposal cooked up by the last government. To which I agree with. To be honest, I don't really know why we have a tax on our own stock market, yet we can go and buy shares in American companies without any stamp duty being applied. Whilst this would be a good starting point to incentivize additional UK investing, it will come at a cost at £4.3 billion in lost stamp duty taxes on shares, which was the tax revenue that was raised back in 2024, according to the Office for Budget Responsibility. And when Rachel Reeves is facing into a black fiscal hole of anywhere between £30 billion to £51 billion, depending on which source that you believe, losing just under £5 billion in stamp duty taxes on shares is probably less than ideal. Broader to all of this, though, I still think there needs to be additional consideration on what actually makes UK markets more attractive and more competitive on a global scale. UK markets have underperformed relative to other countries for quite some time now. This has resulted in lower valuations, which is possibly down to more structural issues around sluggish productivity, a lack of innovation, and poor tax incentives to actually build businesses here in the UK. I mean, to say tech stocks make up just over 1% of the FTSE 100, so like one company, when we've been in this kind of technology era for the past 25 years and an AI era now, which is booming most stock prices to all-time highs, it probably showcases that we've done something fundamentally wrong when it comes to value creation, attractiveness, and competitiveness of UK markets. And whilst getting additional retail investment in UK equities may help a little bit, in my opinion, I don't think it's enough to bridge the gap. And this approach risks being more of a patriotic gesture than a sustainable economic strategy. So look, they're my thoughts. Of course, this is all speculation for now until the autumn budget is released next month. But be sure to let me know what your thoughts are down in the comment section below. Whilst you're over here, be sure to subscribe to the channel. And if you did miss my update on the cash ISA reforms, well, I'll leave a link to that video here that you can check out next. That being said, I'll see you over in the next one.